May profits be upon you. Welcome to another weekly market forecast. We're looking at gold. Gold. All right. Looking at gold futures on the COMEX. Okay. And everybody gets the same price. That's why I love futures over gold. If you look at the gold CFD, XAU, USD, you will see. Come on, come on. This drives me crazy. Why? All right. You will see it looks virtually identical. All right. Very subtle differences, but this is a CFD, and you know, with futures, everybody gets a standard price. Everybody gets the same exact standard price. There is no differences between gold. I mean, the brokers with futures. Everybody gets one standard price that is regulated, and that's the way it is. All right, no weird spreads, no arbitrary slippage, none of that mess. All right, so okay, off my soapbox. What are we looking at? We're looking at, if we go to the monthly, we can see that this has been an uptrend, and a glorious one actually, but it's been impulsive and it just keeps going up. Every so often, we'll see uh, uh, once it made this higher low here, it's been pulling back just for a healthy higher high, higher low, higher high, higher low, higher high. The pullbacks is where you get your opportunity to get in. And what does it do? It leaves a fair value gap, and then it goes a little higher, pulls back with that bearish candle. You can see it pulls, then it impulses again, gives a nice little fair value gap here. Price comes back to that fair value gap and pushes higher. All right, we've got a little tiny fair value gap here. We push up higher. Price reaches back down, pulls up. All right, we pull back again, leaves a beautiful fair value gap developing here. This candle has not closed yet. That's this month, but you can see with the fair value gaps, uh, it's just been one steady push higher. No bearish fair value gaps. That will tell you what the order flow is. If you go to the weekly, you can see these little respites. All right, these little pullbacks give us our opportunities to push higher. We get another pullback, then we push higher. This is all this is accumulation and then distribution, accumulation, then distribution. All right, that's all it is. All right, and we came across a nice one here. It was a lot of sideways action. Then you see the bullish fair value gaps and the impulsive move up. The bullish fair value gap, another impulsive move up. That's all you want to see in an uptrend. All right. There's no reason to look for shorts. No reason to look for shorts. All right. Just longs. They are higher probability. If we go to the daily, this is where we start to see some good stuff. All right. One thing I want to point out is this beautiful uh, bullish fair value gap here. All right. You can see it here. From the top of this candle to the bottom of the third candle. One, two, three. That forms your fair value gap. And what did the market do? Like it was doing before, like it did here. Came back into a bullish fair value gap, went higher. All right. You can see it here. Bullish fair value gap, nice impulsive bullish fair value gap. We come back to rebalance and price pushes up higher. That's what it does. That's what gold has been doing. All right. No reason to go against that. We got the bullish fair value gap. All right. This is, all right, so that I can spell it out for some of you. All right. So, because some of you are new traders. All right. All right. We have internal range liquidity and we have external range liquidity. All right. And how does the market move? Higher high, higher high, higher low, higher high, higher low, higher high. This is an uptrend, right? Every time it pulls back, it's pulling back into internal range liquidity. The highs, the swings, are the external range liquidity. All right. When price makes that high, here, uh, it reaches external range liquidity. It reaches back for internal range liquidity here. All right. And then it moves again. External range breaks that high and creates a new swing high. That's the external range liquidity. It just swapped that external range liquidity and created a new point of liquidity. All right. But what does it pull back into? Internal range liquidity. It hit a fair value gap here, pulling back into that, and then it launches higher, breaking that old high for external range liquidity and creates a new point of external range liquidity up here, a new higher high. And we're looking for it to continue the internal range liquidity seeking and then push higher from there. That's the way this thing works. Okay. Now, I hope you enjoyed that. All right, so we have the high here. This is going to be our draw on liquidity. This is where the market will be drawn to. I believe that we tapped into that internal range liquidity here, and you can see how the market came back and pushed higher. We're past the 50% of this trading range. All right, we're in the what do you call it? Uh, this premium, the premium of the range of this candle. All right, there's a discount below the 50% of this candle range, and there's premium above the 50% of that candle range. If we go down to the 1 hour, this is all I'm going to show you, and then I'll let you go. All right, you can see how that down candle is here, and if you put your Fibonacci retracement tool on it, you can see from the high to the low and the pullback. All right, this is the new bullish candle here. All right, we can see that price has pulled back into above the 50% of this candle range. All right, now normally if it was a downtrend, I'd be looking for a price to find its a resistance area and start to give a break of market structure, a market structure shift to the downside, and then a pullback, and then we would see more of that. But this is not a downtrend. All right, it's not a downtrend. It is the exact opposite. It is an uptrend. All right, market is moving up. So I'm not looking to trade this as for a short. I think that'll be short-sighted, honestly. Um, I'd be looking for a price to come and take that high and this high. Why? Because you could say argue and say, oh, this is an order block here. You know, the market dropped from there, and we're coming back to it. We should be able to take a high probability trade to the downside. No, because this is an uptrend. That's a counter trend trade. Is a lower probability. All right. Also, this high is not this high. All right. It is not the swing high. You understand? The swing high is protected, right? And I'm not on board with this that this correction, and then we're not going to go up higher, but we're going to continue down low. I'm not on that. No, I will wait until this low is traded below. All right. I would wait for to before I start taking shorts, I'd be waiting for this daily fair value gap to fail. I want to see price close below it. All right. Then I would consider the pullback for shorts. All right. But I need to see it fail. I need this fair value gap to turn into an inverted fair value gap. And that's a different explanation, a whole different conversation that we'll have. All right. But right now, everything is a buy. All right. And we're going from internal to external. That's it. Keep it simple like that. All right. Until this candle range is closed below here, then I'll stop looking for buys. We get a close below this low, I'll stop looking for buys. All right. Until I see another shift in the market to push higher. But I'm not looking for sells until we get this. This is actually where where the market would what do you call it? I would consider it a break of market structure. All right. Once we get past that opposing candle there, if we get down to it, I'm just staying neutral until I see price start to break structure to the upside. Give us a clean uh, CISD, because we are in an uptrend. So I'm looking for any excuse to take a buy, and so should you. All right. I'll see you in the next video. Thank you for watching. Make sure you watch the videos coming out after this.